So one big question I think that people will ask themselves as we go through the funds and talk about the expense ratios and things like that is the TSP still worth it? If we talk a lot about low cost index funds like at Vanguard where you're paying maybe 0.03 or 0.04, 3 or 4 basis points, somewhere around there, why is the TSP beneficial for us if I can get a little bit cheaper at Vanguard?
Welcome to the Military Money Manual podcast. Hey guys and gals, Spencer here from militarymoneymanual.com and author of the new book, The Military Money Manual, A Practical Guide to Financial Freedom. Just released last year, available on my website, militarymoneymanual.com, or on Amazon as well. I'm here today with my co-host Jamie to present today's episode on the 5 TSP or 5 Thrift Savings Plan funds. Our podcast is all about achieving financial independence in the military. Every episode of the podcast is designed to help you get one step closer to financial freedom. Just a quick reminder that this episode is for informational purposes only. We're not investment advisors, and this episode does not constitute investment advice.
Hey, Spencer, we do believe that personal finance shouldn't be boring or intimidating, and the ultimate financial goal worth pursuing is financial independence, which is achievable for you within 10 to 20 years of starting your journey, no matter what your current net worth is. Before we get started, we just want to thank you all for the 5-star reviews and the questions that we've had that keep coming in. If you would, please continue to leave those reviews on your podcast app and hit the subscribe button or the plus button so you'll see new episodes each week as we release them. Also, consider what friend or coworker you could share the podcast with this week to help them grow in their own personal finance journey. And as always, if you have any questions or feedback, you can send that to us on Instagram at Military Money Manual or via email at info@militarymoneymanual.com. If you are new to our podcast and the TSP, be sure to go back and listen to episode number 2. It was back in our early stages of the podcast before we had this excellent audio quality like we do now in our high quality recording studios. But everything you need to know about the TSP in detail is discussed in episode number 2.
And speaking of those reviews that people are leaving for us, Jamie, we had one here on Apple, 5 stars. His username is Justin Army Dude, and he says it's a must listen for all military service members and families. This show provides such valuable advice for military members. And so that's from Apple there. So
was that just an Army Dude or Justin Army Dude?
It's just space and Army Dude. Yeah.
Okay. Well, Thank you very much, Just an Army Dude, who maybe his name is Justin. I don't know, but we appreciate you.
Yeah. And here's another one. As a newly commissioned lieutenant heading down to pilot training this year, finding the podcast has been incredibly beneficial. So that's awesome. That's also from Apple, where we've got 5.9 stars. It's actually 26 5-star reviews and 1 1-star review. So if you left the 1-star review on our podcast on Apple, we implore you, please go ahead and maybe just bump it up to 2 stars. Today we're talking about the 5 TSP funds. And before we get into the weeds here, and we are going to get into the weeds here, one concept that I want to introduce is costs and expense ratios. So what expense ratios are, you'll hear people reference this when they're talking about index funds, whether they're at Fidelity, Schwab, Vanguard, or in the TSP. And what it is it's a percentage of your portfolio or of your asset that the fund manager takes every year. So if you have a financial advisor, they might be charging you, like at Betterment, they charge 0.25% per year as an investment management fee. But that's actually on top of the expense ratios of the underlying funds. So if you go and click in, like if you have a Betterment account and you click on the funds that you're invested in, those funds will have underlying expense ratios. So the nice thing about the TSP is you only have really one expense ratio to worry about, and that's the expense ratio of the fund, because there are no financial advisors for the TSP other than like if you had a third party one. And a basis point is 1% of 1% of a decimal. So you'll hear us talk about, well, that fund has a 0.01% expense ratio. And that gets really confusing when you start using decimals. Yeah. So one concept that we like to use is the basis point, where 1% of 1% becomes 1 basis point. So if we say, hey, that fund has a 0.049% expense ratio, we can also just abbreviate and say that has a 4.9 basis point expense ratio. And then that lets us easily compare expense ratios to each other. So if you had a 1% expense ratio, that would be 100 basis points. If you had a 0.01% expense ratio, that would be 1 basis points. And then you can easily tell that, hey, the guy who's charging 1% is 100 times more expensive than the guy who's charging 0.01%. Everybody confused now? Clear as mud? So that's the basis point. And getting into the 5 TSP funds, usually the expense ratios that we'll be talking about will be 4.3 to 5.9 basis points. So we're talking about less than 0.1% for the total cost of owning these funds. And another way to think about that is think about like for every $1,000 that you have invested, you're paying, if it's a 4.3 basis points, you're paying 43 cents for every year for every $1,000 you have invested. Or if you have, and then you can just do the math after that, $10,000 would be $4.30 a year that you're paying in expense ratios. And you can, at first, it doesn't seem like a very large amount, but as your net worth grows and as compounding interest takes effect, and what starts as just a few $1,000s of contributions when you're in your 20s can easily and quickly grow to $1 million of net worth in your 60s or even earlier, and all of a sudden your expense ratios start to matter a lot.
Yeah, thanks for explaining that in such detail, because a lot of times you get lost in the financial jargon, and sometimes you're just afraid to ask, or you end up Googling it and finding some blog that may or may not have a good explanation or accurate explanation of it. But so like you said, today we're going to talk about the 5 TSP funds, and they're all identified by a letter. So can you run down the 5 TSP funds for us and just kind of a brief overview of each one?
Sure. So first thing to understand about the 5 TSP funds is that they're all passive index funds. So the way that they've been set up is there's no active manager behind them. Every fund has an index, or you can think of it as like a concept or an idea of that fund, and that's how the funds are invested. So there's no human going out there and picking the funds. It's just basically a computer that spits out, hey, I think that these 500 companies should be in this fund, and then the fund manager says, yep, that makes sense, and then they go and purchase it. Whereas if you had an actively managed fund, they might think, like, one of the popular ones over the last couple of years has been ARK Investments, and they invested heavily in Tesla because they thought Tesla was going to do really well, and it did do really well for a couple of years there. But now if you look at ARK Investments over the last, I think, year to date, they're down like, something like 50% or something. So that's the example of an active fund manager where they're picking the stocks and they're picking the bonds that they want to be invested in. Whereas a passive index fund manager, they don't do any of the picking. They just have the fund, they just have the index that they're following, and then that's it. So from a high level, you have the C fund, the S fund, the I fund, the F fund, and the G fund. Starting at the most risky, you have the I fund, the S fund, the C fund, the F fund, and then the G fund. So that's moving from highest risk to lowest risk. And that's taking you from an international stock index fund all the way to a government bond investment fund. So on the C fund, we'll start with that one just because that's the largest fund in terms of market capitalization, I think. That's the Common Stock Index Investment Fund. So the easiest way to think about this is it's large and mid-sized U.S. company stocks. And when we talk about large and mid-sized, we're talking about their market capitalization. So we're talking about all you have to do is take their share price, multiply it times how many shares are outstanding. So let's say for Amazon, if there was 1 billion shares out there and each one cost $1,000, then the market capitalization of Amazon is $1 trillion. And for the C fund, if you ever hear anybody refer to the S&P 500 or the 500 largest companies in America, that's what they're talking about. They're talking about the C fund. So the C fund, the index of the C fund follows is the S&P 500. And that's, the largest companies in America. So you're talking about your Amazons, your Microsofts, your Googles, Tesla's on the list now. And it's all just sorted by market cap. So at the bottom of that list, a lot of times those companies will change every year. And that's what the job of the index fund manager is to sell shares of companies that fall off the index and then buy shares of companies that come onto the index.
Mm-hmm.
So there's about 4,100 publicly traded companies in America. And when you buy the C fund, you're buying 500 of them, the 500 largest of them. If you look at the lifetime returns of the C fund, it's a 11.13% versus the index, the S&P 500 index is 11.15%. So using our basis points, you have just a difference of 2 basis points there over the entire lifetime of the index fund. So that's like very negligible over the long run, just 2 basis points. And it's very comparable to the S&P 500.
Because it's a benchmark of the S&P 500, it'll kind of go up and go down with the stock market. So, right now, early 2022, the market's kind of down, world events, or when COVID happened. So you'll see a little bit more volatility in there, just like you would with normal stock market, right?
Absolutely. One of the ways that you can check to see what your daily performance of your C fund is going to be is either go to Google or go to Yahoo Finance or wherever the stock app on your iPhone. But if you type in VOO, Victor Oscar Oscar, that's the S&P 500 index fund for Vanguard. Or you can type in SPY, that's the SPY. I think it's the iShares 500. It's the iShares version of the S&P 500 index. And whatever percentage that goes up and goes down is what the C fund is going to do. So the TSP is they're very slow to report performance numbers just because of the way that it's set up. You're not day trading with your TSP account, or at least you shouldn't be.
Yeah.
And so if you want to kind of know what the TSP or what your C fund did on a day-to-day basis, you can just go and look up the like I said, the SPY ETF exchange traded fund or the VOO exchange traded fund.
Cool. That's great. So C fund is kind of a benchmark and a foundation of a lot of different strategies out there for the TSP. Let's move to the S fund now. What does the S stand for, and how does that one composed?
So the S fund is the small cap stock index fund. So the S is, you can think of that as small. And that's everything else in the US. So we talked about how there's 4,100 publicly traded companies in the US. And the 500 of them are in the C fund, the largest 500. But the other 3,600 have to go somewhere. So they go into the S fund. So that allows you to, by purchasing the S fund, you're purchasing all the companies that are smaller than the 500 largest companies in America. And a lot of people, when they talk about investment strategies, they might talk about having like a small cap tilt. And that's when you own more small cap index fund allocation than the market capitalization would dictate. So, but there's also other ways of doing it. You can just do a market cap weighted investment portfolio where you own a ratio of C fund to S fund that simulates the total US stock market. And usually that's about a 4x or 4 times multiple. So if you have 60% C fund, then you want to have 15% or a quarter of that money in the S fund. And like I said, it's everything else in the US. So it tracks an index called the Dow Completion Index. And lifetime, the S fund has returned about 9.7% versus the Dow Jones Completion Index returned 9.6%. It's negligible, again, within the margin of error there.
So it just gives you a little bit more diversification of the stock market compared to just the largest 500 companies. Is that kind of the main difference between the C and the S?
Absolutely, yeah. And if you want, if you're following kind of the Jack Bogle theory of just buy everything and hold it, then you got to have some S fund in there, because if you only own the S&P 500, then you're purchasing Tesla when it's already one of the largest companies in the world. Whereas if you had bought the S fund 5 or 10 years ago, you bought Tesla when it was a small cap company. And so you've been able to get the returns of the companies that grow and eventually become S&P 500 companies by purchasing the S fund. The other thing to note, though, is the C and the S fund track each other pretty closely, and when you own both of them, then you're owning every single publicly traded company in America, and that's a great diversification tactic right there. I talk about my book, the LADS, or the low cost, automatic, diversified, and simple method of investing. That's how I do all my investing. And when you own the C fund, you own the S fund, you're diversified, it's simple, it's extremely low cost. and it's an automatic way to invest in the entire US stock market.
Awesome. So the next one on the list is the iFund, or the International Stock Index. What's that one about?
So this is owning shares of companies outside the United States. I don't like this fund, and it's not that I have a personal vendetta against it, but it doesn't accurately represent the entire world. It's very heavily weighted into Japanese stocks. So 22.5% of the iFund is made up of Japanese stocks. And then the next couple funds, or the next countries that make up the index, are United Kingdom, France, Switzerland, and Germany. And you'll notice, China's not on there. You'll notice that there's a lot of big markets that don't get included in the iFund. And a lot of that is for political reasons, because it doesn't look good when you have the US government essentially investing in other countries. But I think you miss out on a lot of the potential growth if you want to be a global investor. There's this idea called home country bias. And if you look at how people invest all over the world, so if you look at Australians, they tend to invest in Australian stocks. If you look at people in the United Kingdom or France, they tend to invest in their own country stocks. It's the same thing in the US. People in the US tend to buy US stocks. But I think you miss out on a lot of the potential growth around the world if you're not owning Alibaba, if you're not owning, a lot of these countries, South Korea, for instance, which I think actually is in the... No, it's not. So like South Korea isn't in the iFund. And having been there, I mean, that is has a huge economy and
Yeah.
a lot of consumers there. So you just miss out. And that's something that you would get if you, say, bought VT, which is the Vanguard Total World Stock Index Fund, or the other one is VTIAX, or is their Admiral Shares version of the Total World Stock Market, except US Index Fund.
So it's going to be similar, but not quite the same, because of the way that the TSP International Fund doesn't quite represent the emerging markets, right? So there's
absolutely, yeah.
Those are not quite identical. I forgot to ask real quick if I can jump back to the S fund. You mentioned for the C fund tracking it, if you wanted to look at it on Google with SPY or VOO. What about for the S fund? Is there something I can look at to track that one a little closer?
Yeah, so for the S fund, you can look up Victor Bravo VB. That's the Vanguard Small Cap ETF, and that'll kind of show you how the small cap market did over the last day or two. The other index or ticker you can look at is DWCPF, Delta Whiskey Charlie Papa Fox, and that's going to be the Dow Jones US Completion Total Stock Market Index. So that's the actual index that the S fund is following. All right. So for the I fund, Jamie, it's going to be EFA, Echo Fox Alpha. That's the iShares MSCI EAFE ETF. So that's complete alphabet soup right there. The military would be very happy with that one. I'm sure we could add a couple more acronyms in there. But yeah, that's the EFA, and that's going to be tracking the same index with Europe, Australasia, and the Far East that the iFund is made up of.
Okay. And did we say yet, if we didn't say it, the lifetime performance of the iFund?
So the iFund is going to give you about 5% versus 4.9% on the EAFE index. Again, it's a negligible difference there, but international funds have not performed very well, especially compared to US funds in the last 10 or 20 years. They might have their day again. And, every time someone's like, oh, international's dead, emerging markets are dead, well, then they end up being like the best performing, asset class the next year. So I wouldn't count them out yet. International funds, a large portion of my portfolio, 25% is allocated to international stocks. So I do think that international stocks have a future, and they could be in the future uncorrelated from US stock market performance. So there could be a scenario in which the US stock market's down, but international stock markets are up. It hasn't happened in a long time, but there's potential out there.
Yeah. Okay, cool. So moving down the list, the next one is the F fund.
So the F fund is your fixed income index investment fund. Again, it's a mouthful, but it tracks the Bloomberg Barclays US Aggregate Bond Index, which is just a broad index representing the US bond market. It's a pretty simple fund. They invest in high grade, AAA rated corporate securities. All that mumbo jumbo just means that when, let's say, Citigroup needs to borrow some money, it'll issue a bond and the F fund will go and purchase that bond. And then Citigroup will pay 5%, 6%, whatever the interest rates are at the time, back to the F fund. It's 5.7% lifetime return average versus same 5.7% for the bond index, the Barclays that we talked about there. It's a great fund if you want to add some bond exposure to your fund. The other way to kind of understand what the bond funds aren't really something that you should be checking every day. They're kind of like a set it and forget it. They shouldn't be that volatile. Right now, it might be changing a little bit because interest rates are kind of bouncing around, but you really want to have bonds in your portfolio to outweigh the volatility of your stock market index funds.
Okay. And the last one, is the G fund, which, like we said in episode 2, I think does not stand for good. It has its role, but as far as performance goes, it's not necessarily the highest performing one. So talk about the G fund a little bit.
So the G fund is a 4.7% lifetime return, which sounds great until you look at like their 10-year performance. It's like 1.94%. And the G fund gets a bad rap because originally everybody, when you signed up for the TSP, they put them in the G fund because they didn't want to be accused of misallocating or investing people's money. Thankfully, that's changed now. And when you open up a TSP, your funds are automatically contributed to the Lifecycle Fund, which is most closely correlated to your retirement date. So for most of the guys and gals coming in right now, that's going to be the L2065 fund. And we'll talk a little bit about Lifecycle Funds in just a second. But the G fund, it gets a bad rap, but it's actually, it serves its purpose. If you want a bond fund that is inflation protected and provides a stable return and it doesn't go down, it might not go up very much, but the beauty about the G fund is it preserves its purchasing power because it purchases short-term U.S. Treasury securities from the United States government. I know it's kind of weird because the TSP is kind of a government agency too.
Yeah.
And it's so, but it just shows like it all just goes around, right? Like money is completely made up. And, but what they're doing is they're purchasing these short-term U.S. Treasury securities and you're getting a pretty good return in the long run for a bond fund, and you have the guarantee of the United States government. So as long as the U.S. government continues to exist in a way, shape, or form that allows it to pay its debts, and every time we run into the debt ceiling, the G fund is threatened by that. But so far, the Democrats and Republicans have been able to agree to continue to increase the debt ceiling, and hopefully that will continue to happen going forward, or they'll find out a way to stop, bringing on so much debt.
Going to debt.
But
that'd be the ideal one for me personally.
Yes. Yeah. But until that happens, which we might be waiting a long time, the G fund's there for you. So, and especially in an inflationary environment, you want to own a lot of stocks because as prices rise, hopefully companies raise their prices, and so they continue to make more money. But you can also have a lot of your assets some of your assets in the G fund as well, which should be inflation protected because the way that it purchases securities. So again, we talked about 5 TSP funds ranging from the most risky, or the International Stock Index Investment Fund, or the I fund. Then the S fund, the small cap fund, the C fund, think S&P 500, the F fund, which is your fixed income index, and then the G fund, which is your US government bonds as the most secure and the lowest risk. Also, though, remember, with lowest risk comes lowest returns. With higher risk comes potentially higher returns. That's the way that capitalism is set up. If you don't take on as much risk, then you don't make as much in returns.
Yes, very, very true. All right, so you mentioned a minute ago, Spencer, the Lifecycle Funds. So can you explain what a Lifecycle Fund is? You mentioned 2065. What does that mean, and what other options are out there, and then how are they composed?
So the lifecycle funds are made up of the 5 core TSP funds. So if you understand the 5 core TSP funds, then you can understand the lifecycle funds. And a lot of times I'll see people mix the 5 core TSP funds with the lifecycle funds, and they're not really designed to do that. The lifecycle
Hmm.
funds are there to be a target date retirement fund. They're there to be a set it and forget it, put all your money in here, and you have professional investment managers allocating your money in such a way that you take on a lot of risk when you're younger, and then you take on a little bit less risk as you get older. So, what that means for the L2065 fund is it's invested. Well, let me back up. When we say L2065, what we're talking about is somebody who's going to be retired within plus or minus, let's say, 5 years in 2065. So if you were born
Okay.
in the year 2000 and you're expecting a normal retirement, or what most people consider a normal retirement of 60 or 65 years old, then you probably want to be invested in the L2065 fund. For anybody, who's going for financial independence, you probably don't want to pick a life cycle fund that corresponds to your early retirement or financial independence day. You actually probably want to pick one that's later, because the whole point of financial independence is to have assets that are going to grow faster than inflation.
Yeah.
And that usually means having a lot of stocks. You don't really normally want to have any more than, let's say, 50% of your portfolio in bonds, or else you risk having failure over long periods of time of your portfolio. So the life cycle funds are broken up into 5-year chunks. So I think the closest one to us right now, tell me if I'm wrong, is it 2025, or have they moved on from
I
that
think
one?
so.
Yeah.
I think you're
Yep.
right. Oh, yeah.
There is a 2025 one right now. And then there's also, so once you're done or once you retire, the life cycle fund transfers into they call it the life cycle or the L income fund. And that's the most conservative. So that's going to have a lot of bonds and not so many stocks. But yeah, right now there's a L2025 fund, and there's the furthest one out is the L2065 fund, and probably in about I think as they sunset. So once we get close to 2025, then the 2070 fund, L2070 fund, will come out, which is pretty crazy to think about.
Yeah.
2070.
I'm sorry. You mentioned that it automatically assigns new enrollees to the one that matches them. So if they enlist this year, for example, they'll get enrolled in 2065. Do they still have the ability to go in and change it to 2060 or 2055, or they can make their portfolio more or less conservative, right?
Absolutely. Yep. And if you don't want to do the life cycle fund, you want to set up your own asset allocation, and we'll talk about that in a future episode. You can pull all your money out of the life cycle fund and put it on the G fund if you want, or put it in the C fund you want, or put it into an asset allocation that's appropriate for you. So, I really like what they're doing, where if you sign up for the TSP and you just contribute your 5% and get your 5% match, and you don't even open up your TSP account, it goes into the L2065 fund. And for most people, if they never looked at their TSP and they max it out every year, let's say for 20 years, and then they open it up at age 60, they're going to be shocked, I think, at the size of the number in there. I mean, we're talking
Yeah.
millions. And that's
Yeah.
a great thing. Whereas if they had put it all into the G fund, they'd still have a lot of money in there, but they wouldn't have as much money in there when you're talking about 30 or 40 years of compounding returns from money invested in the US stock market.
What about the expense ratio? It seems like there's a little bit more going on, or a little bit more intentional planning for the life cycle funds. Does that mean they're more expensive?
No, not really. So, I mean, the most expensive fund, TSP fund, is, I think the I fund is 0.059%, or 5.9 basis points, like we talked about earlier. And the Lifecycle 2065 fund is 4.9 basis points. So you're actually 1 basis point cheaper. And that's because it's an average of the 5 funds that are in there. And it has a lot more C fund and S fund than it does I fund.
Yeah.
speaking of the composition, so the L2065 fund, 50% C fund, 35% I fund, 14% S fund, and then less than 1% F and G fund. So, a lot of people like to talk about, oh, the life cycle funds aren't aggressive enough for me. But if you look at the L2065, it's less than 1% bonds. I mean, that's a very aggressive portfolio for most
Yeah.
people to have 99% of your invested assets
It's more
in
aggressive than what I
stocks.
have.
Yeah, exactly. It's
Yeah.
more aggressive than what I have.
Yeah.
And that's a pretty large allocation to international shares as well. So, and it stays that way until 2037. So it really doesn't adjust very much for the next 15 years. And what I like
Yeah.
about that is I think the life cycle funds are a great place for people to park their money. It's aggressively invested into US and international stock market index funds. And then it's going to sit there and it gives you a chance, the next 15 years. Oh my gosh, can you imagine like how knowledgeable you could become about asset allocation and building
Mm.
your own portfolio? I mean, you could probably read a book called The Military Money Manual and learn just about 80% of what you need to know about it. But it's a great place to start. It's a great place to learn about asset allocation. And then if it's too conservative for you or not risky enough for you, then you can move your money out and you don't really have to worry about it. The 2065 returns were 21.19% lifetime. Now, granted, like this fund just came out and it had, I mean, it was probably released in 2020, right before the COVID dip. But if you compare that to the L income fund, it only returned 4.24% lifetime. And that's because, again, it's invested super conservatively into it's probably got a lot of G fund and a lot of F fund.
Awesome. So one big question I think that people will ask themselves as we go through the funds and talk about the expense ratios and things like that is the TSP still worth it? If we talk a lot about low cost index funds like at Vanguard where you're paying maybe 0.03 or 0.04, 3 or 4 basis points, somewhere around there, why is the TSP beneficial for us if I can get a little bit cheaper at Vanguard?
Well, I think once you're below 10 basis points or 0.1%, you're really splitting hairs. I know Fidelity has index funds that are zero. There's zero expense ratio. And the way that they can afford to do that is one, it's a marketing thing, right? They want to attract people because they're selling
Mm-hmm.
0% funds, and then they can hopefully sell some of those people into higher fee funds. But the other way they do is they sell shares to short sellers, and they're able to make enough money off of that they can cover the costs, and they can offer 0% expense ratio index funds. So at this point, at Vanguard you can get their VTI total U.S. stock market index ETF for 3 basis points. I know at Schwab they have similar funds that are extremely low and probably cheaper than Vanguard. But even though it's extremely low and we're talking about a few basis points, I think the TSP is still worth it. And I'm not just saying it's worth it because at this point we're completely splitting hairs when we're talking
Yeah.
about basis points. I think it's worth it because it's your largest tax advantage retirement space that's available to military service members. So if you're not putting money into here, well, where are you investing your money? And if it's into a taxable brokerage account, okay, that's fine. But eventually you're going to be on the hook for short-term or long-term capital gains tax. And you're
Mm-hmm.
not taking advantage of, especially in the military, you have extremely low taxable income. You should be stuffing your Roth TSP account full every year and letting that grow for 30 or 40 years. And then when you're 59 and a half, you've got $1 million in there tax free that you can be pulling out. And because you already paid the taxes on it, and they were probably extremely low when you were in the military. So, and the other thing too is if you don't like it, if you think the TSP isn't worth it anymore because it's 1 basis point more expensive than Vanguard, then you can move your money out. So, after you've maxed out your TSP for a couple of years while you're in the military, once you leave the military, whether that's retirement or separation, you can transfer your money to an IRA, you can transfer it to another company's 401k, and it's not the end of the world to have your money locked up in the TSP. But it's not locked up, right? You can move it out.
So one other question, someone, maybe they're inspired by this podcast, maybe they've been in the military a little bit and they're only in the G fund and they've never really looked at it before. What options do they have on TSP.gov to move their money around? You mentioned that it's not really a day trading asset and there's some limitations they place on us to keep us from day trading, but we can move money around inside of our TSP portfolio, right?
Absolutely. Yeah. So log into tsp.gov. If you don't have an account set up, go to MyPay. Make sure that your address is correct in MyPay, because when you go to create a TSP account, they're going to physically mail you your password the first time, which I think is going away in the new 2022 changes. But at least last time I checked, that's the way that they're still doing it. And yeah, you can log into your tsp.gov account and you can set up a interfund transfer. And let's say that you've been putting money into the G fund for years. You can say, well, I'm definitely going to stop putting in the G fund. Let me put it into the L2065 fund, and then I'll come back in a few months after doing some research and I'll figure out how I want to divide it up. But if you're pretty sure, you've listened to our episode about asset allocation and about the different portfolios you can build in the TSP, which is going to be a future episode. So stay tuned for that. If you've listened to that episode and you think you're ready to go build your own portfolio, then go for it. Allocate your funds to the C fund, to the S fund. And then the other thing you want to make sure you do is set up your if you're still in active duty or guard or reserve and you're still getting a military paycheck, make sure your contribution allocation is set up correctly as well. So the interfund transfer is just going to move money that's currently in the account, and the contribution allocation is going to set up future money that you deposit into the account. One thing I'll mention real quick, in 2022, I think it's in June, the TSP is going to go through some massive changes, and we're going to have an episode about that. But they're actually changing the name. So contribution allocation used to be how money that flowed into your TSP was allocated. That's going to be called investment election. And then the interfund transfer is changing to a reallocation. That's the new nomenclature that the TSP is going to, and that's going to be taking effect after June of 2022.
All right, that's great. This is a good detailed review of the 5 funds of the TSP. And if anyone wants to dig in more into the TSP, do you have a website or blog post that you want to refer them to?
Yep, head over to militarymoneymanual.com and search on there Thrift Savings Plan, or just Google Thrift Savings Plan Military Review. And I've got a post up there, which will be updated soon with all the changes coming in June 2022 to the TSP. But the one change that's probably not going to happen for years and years, if ever, is the index funds. So the C, S, I, F, and G fund, probably not going anywhere, I would say, for the next 100 years.
Thanks again for joining us today for this episode on TSP Funds. As a review, we talked about the 5 funds available in the Thrift Savings Plan, the C, S, I, F, and G, and the Lifecycle Funds that make it even easier for you. Remember, the TSP is an incredible benefit for your retirement savings goals and is very low cost. If you haven't yet, go back and listen to our most popular episode of the podcast. That's episode number 2, where we discussed all the nitty-gritty details of the TSP.
If you're enjoying our podcast, we would appreciate a 5-star review on Apple Podcasts or Spotify. All the reviews we've received so far have been great, and we certainly do appreciate them. Subscribe to the podcast so you don't miss future episodes. Hit the plus or the little alarm bell so you get notifications. And if you have any questions or feedback, please message us on Instagram at Military Money Manual or email info@militarymoneymanual.com. If you want to support what we're doing here on the podcast, my new book, The Military Money Manual, is available on Amazon Prime with free shipping, Kindle ebook, and Audible audiobook. Thanks again for listening, and thanks for being the best part of the Military Money Manual community. We'll see you on the next episode of the Military Money Manual podcast. Hey guys, it's Spencer again. Before I let you go, I want to let you know about my new book. It's called The Military Money Manual, A Practical Guide to Financial Freedom, and it's available right now at militarymoneymanual.com/book. This is the book I wish someone had handed me on my first day in the military. In this book, I cover the exact money tactics, investing strategies I use on my path to financial independence before age 40. I break down the math of FI and I explain the exact dollar amounts you need to retire.
The book is full of easy-to-apply financial advice specifically for military service members and their families. I cover tax-free deployments, the thrift savings plan, and many more topics only military personnel can relate to. This book was written specifically for you, whether you're active duty, guard, reserve, a military spouse, enlisted, or officer. Both E's and O's will benefit from the lessons in the Military Money Manual. If you're in the Army, Navy, or Air Force ROTC, or if you're a cadet or midshipman at West Point, Naval Academy, and the Air Force Academy, this is the perfect book to start your military career with. Again, the book is available right now at militarymoneymanual.com/book, in audiobook, ebook, and my personal favorite, the hardcover book. The hardcover book was printed right here at home in the United States of America, and it will look great on your bookshelf. So check it out. Let me know what you think. And remember, podcast listeners can use promo code PODCAST to get a special discount. It's called The Military Money Manual, A Practical Guide to Financial Freedom, and it's available right now at militarymoneymanual.com/book. Thanks for listening.